EBITDA multiples and valuation ranges. Last week we talked about EBITDA and what that number means, how it's computed, how it's reconciled and recast and kind of optimally discussed with prospective acquirers of businesses. But the other part of that equation is what is the multiple applied to that EBITDA and valuing the business. And so when a prospective acquirer looks at a company to buy, look, there are instances where they're buying a technology, a solution, a very specific thing, and the conversations about how much it would cost to build that versus buy it. That's one type of conversation. There are other types of conversations when someone's looking to really just access the customers and the sales, where they'll pay a multiple of revenue. But the vast majority of mergers and acquisitions, particularly in the middle market and in our experience, is predicated on an EBITDA multiple. So the company will be valued at some number multiplied by the adjusted or recasted agreed upon EBITDA, or pre-tax cash flow. And so that multiple tends to correlate with the size of the business. The larger a business is, the higher the multiple will be. So you'll hear this expression of EBITDA expansion as a business grows. And so that being that obviously the profitability of the company will grow as the sizing of the company grows. However, the multiple applied to that will grow as well. And that's really where a lot of value creation is, right? And so that's why you'll see companies that say, look, we're going to buy 100 different dental practices. That's why we're going to buy 10 different distributors of this. That's why we're going to buy 5 different software companies in this vertical. Because the idea is, as you aggregate EBITDA, which is kind of a strategy that a lot of private equity firms implement, is this aggregations, these roll-ups that you'll hear the phrasing of, is once they do that, there's a higher multiple applied to it. And as there should be, right? Because as a business grows, its product, service, or offering becomes more durable. Its machine-like qualities of the business become more evident in that there's less key man or women risk. There's much more cohesiveness amongst departments. There's more division of labor. And so by virtue of doing that, the machine of the business is more matured, more developed, and there's value there. And secondly, there's a broader audience of prospective acquirers the larger a business gets. And so we have the space that we focus on, $400,000 to $4 million of EBITDA, covered entirely, and there's thousands of participants in it, both from the smaller end to the larger end, and many more joining it every single day. But certainly as you move upward in that chain, it becomes more and more participants. Think of a private equity firm or an institutional investor in a business, right? Their business, their job is deploying capital. And so if they can deploy capital into larger situations, then it's oftentimes the same amount. We used to say same work, different deals. A lot of acquirers will take the perspective of the same work, different deals. They're going to do the same level of analysis. And so if they can deploy more capital by gaining that conviction relative to a particular thesis, then a lot of times they'll want to do that to larger situations. And so you'll see the multiple expand both because of the sophistication of the business and the size of the profitability, but also because there's just a broader audience of prospective acquirers, and you start to get into the supply and demand economics of their wanting deals, and there being less larger deals than there are smaller deals. And so in any event, cut to the chase, and probably the most desired takeaway from this video is, if a company is generating at the lower end of the spectrum that we're involved with, say $400,000 to $1 million of EBITDA pre-tax earnings, you will see a multiple of typically what we're able to generate is 4 to 6 times EBITDA for companies of that size. For the $1 to $2 million EBITDA range, you're going to see 5 to 8 times EBITDA. When you get into the 2 to 3 million range, we'll oftentimes see the lower threshold be 6 times, heading towards 8, 9 times EBITDA. And as you clear through $3 million of EBITDA, and so some of the larger deals we work on in that $3 to $4 million EBITDA range largely, you'll still see 6 times for certain situations. However, you can get into double-digit EBITDA multiples depending on the situation. And again, there's a bell curve for every process. There's going to be a dispersion of data points. This isn't as efficient as the public markets, and so there needs to be lots of conversations. There needs to be lots of dialogues. There will always be people that lob in lowball offers, and ideally there'll be some people that really want a situation and will pay a premium for it because of the way it fits into their larger business or their larger thesis. However, the ranges that we just discussed are going to be kind of the meat, or within one standard deviation, or whatever the phraseology is, right, for a bell curve. And so in any event, that's to give you a general framework of the situation. Again, industry, the product, the service, the offering, the geography, the demographics, the there's a lot of considerations that will skew as to which end of those field goal posts you're in, how much you're going to see kind of outside of that range on the low side, how much you're going to see outside of that range ideally on the high side. And we will advocate and we will isolate and we will really crystallize what those variables are that can enhance a situation. However, these are just some general guidelines, as it's a question that often comes up in our discussions. And so that's a thought for today. EBITDA multiples. If you know what the EBITDA is, what multiple do you apply to it? Oftentimes it's very directly correlated to the size of the business. I hope the week's going well for everyone. Keep pushing forward. God bless. We'll see everyone next time.